Okay, so we got a loaded one today, guys. Gonna be a lot of information. So the first thing that we're gonna do here is just, oh, you know what?
Wait, you're not sharing your screen.
Yeah, I know. I know.
I thought you were sharing it.
I got my thing on my vertical monitor, my Zoom, and it's the layout's way different. So I'm trying to figure out how to use it. Okay. You guys can see?
Yeah.
Yep.
Yeah.
Okay.
Yes.
Alrighty. So first thing we'll do is just review what we learned yesterday about, did everybody go through that PDF?
Yep. For me.
The one
Okay.
about
Yep,
managing and executing.
Like, no, about POIs. Yeah, well, there's a little bit of a video on that, I think. But the one about POIs, the POI guidebook.
I don't know, to be honest.
Oh, okay. Well, I uploaded it to the website, so I'll go check it out after. But that's what we're going to talk about just now, so I can see if everyone kind of gets it. Okay, so who wants to tell me about these three POIs? Anybody hop on the mic. What is an OB?
OB is basically
You want to draw it out for me?
yeah. Let me just take a pen. So let's say we have this candle like right here, then we have some candle form right here, and then the last one like right here. But sorry, this should be like bigger. So basically it needs to break above, and then like we are gonna take this as a POI. If the wicks are big, we are gonna take only the body, and then if our wicks are low, we're gonna take the whole candle.
Yeah. Okay, cool.
Literally
So
like this.
yeah. Okay, so that's how it's traded. Let's draw this out here. Okay. Okay, ignore the colors, all right? Okay, so OB is the most basic thing is the last down close candle. So a bullish order block, meaning that like supply and demand, you know, it'd be the last down move before the up move. So it's a little bit different than supply and demand, but it is a form of supply and demand. The last down candle before the up move, which would be where we measure from. So this would be like your whole order block here. We want to see it come from a sweep or a draw on liquidity, right? Okay. Right, so we want to see this come from some form of draw on liquidity, right? It's the last down close candle with the biggest body, so the biggest area of between the open and the closing price, so most pips. If we see up candles after it, it doesn't matter. If we see a little candle like this that pierces below, it doesn't matter. What we're looking for is that last one with the largest body, right? So we can have candles like this. These are not the same thing, right? When price comes up and breaks out of this region here of the order block, then it's confirmed and we can look to buy inside and expect higher prices, okay? The opposite, if I click Alt-I, I'll flip the chart. The opposite can be said about a bearish one. So this would be an up closing candle. Doesn't really matter about what's happening next to it, as long as these ones aren't bigger bodies, they're not like closing significantly above it. We're looking at this one as our order block. So the reason we're looking at the biggest body is because that signals institutional involvement, right? When an institution places orders, we expect, you know, large price movements. So what happens is they'll push price down into the draw on liquidity, take that, take longs, and then they have to come back and mitigate those positions before continuing, right? So if you were paying attention to the, or if you haven't watched it, that's fine. If you were paying attention to the video series that I released with the PDF, we don't necessarily need what you guys know as inducement before, like, because this is the inducement, right? The sweep is already the grab on liquidity. When we leave and come back to mitigate, it doesn't matter if there's inducement. If the order block is valid, it will get a reaction. Zuby, did you want to say something?
Yeah, so is it like it has to be engulfing the biggest previous candle?
Yeah. So we want it to be the biggest down close candle in an up move and the biggest up close candle if you're expecting it, you know, in a down move to be bearish. Of course, you want to pair this, in with like time of day, which we're going to be talking about all today is all about time of day, or time and price rather. And also your higher time frame bias, right?
Right, clear.
Okay, what's an FEG? What makes an FEG? Anybody can hop on the mic.
The fair value gap, the gap between the first and the third candle.
Yep.
The space in between the wicks is a fair value gap where the orders hasn't been filled yet because the movement was too impulsive.
Okay, perfect. Now what is that signal in between?
The price has to come back at least to that point to react again.
Yeah,
Continue
So-
being bullish or bearish.
perfect. So price doesn't have to come back, but we understand that when it does, this is an area of liquidity. So instead of how you guys I don't know, wherever you came from, how you view liquidity, maybe like equal, excuse me, my God, I need water. Equal highs and stuff. But this is a form of liquidity, right? Liquidity is just residual orders in the market. This could be stops or it can be unsatisfied supply and demand, basically. Like there are residual orders that, you know, businesses, governments, whatever, right? Forex is the market of the world that reside in this area. There was a sell side imbalance, buy side inefficiency. So plenty of the buy orders that reside in here did not get satisfied. So price comes back into this area, rebalancing it, fulfilling these orders before continuing in the intended direction, right? So that's all an FEG is. Correct. We have candle one, candle two, and candle three, right? So candle three closes the FEG, candle one opens it, candle two, the body between the wicks is the FEG. Where do we place our stops if we are to trade an FEG? Right? If we are to trade an FEG, where do we place our stops? Okay. Anybody?
At the wick.
It's the candle. It's the FPJ.
Yeah, so you can place your order at just in the FEG, target whatever your next draw on liquidity is, and your stop placements are either above candle two, the high of candle two. So let's just put a wick in there. Right, so there's candle two, high above candle two, or if you want to be safe, less risk, you would put it, let's do this, above the swing high. So most of the time that's candle one if you're just coming from a draw on liquidity, right? So let's say that this is some sort of higher time frame POI you're coming into. Most of the time it's candle one, so you can put your stop above there to be safe. But in some cases, when you're already, you know, starting to trend, the swing high might be a little bit higher in the leg, and you'd put it above that instead. Okay. Simple stuff. Breakers. What is a breaker?
It's the last up candle or down candle that cause the break of the structure and then also creates fair value gap and then comes back into that breaker and just moves.
Okay, so if I do this, right, let's just draw this out real quick. It's a little smaller. Bear with me. Oops. Bear with me for a second. Oops, oh my God. Okay, so where is the breaker block in this case?
In this case, it should be this candle that caused this.
Yeah, okay. So this is a breaker block is an order block, failed order block. Okay. So we have an OB, right? So in a downtrend, what we would expect out of this candle is that we push down, then hold it as resistance and continue down lower. So what we want to see for it to become a breaker is that order block fails, but with displacement, right? So we don't have much resistance before breaking through. We kind of just displace through heavily. And this gets, you know, unaware institutions on the wrong side of the market. And then as price pushes back, they mitigate out of these, you know, losing positions. And then that acts alone as more fuel to then push price up, right? We won't come back down to the furthest point. We would just come back to that start here. If there is resistance before breaking out, this is a weaker breaker. So we're going to call this a breaker now. This would be a weaker breaker because a lot of that liquidity that resides, that wasn't, you know, the orders that weren't closed off due to this imbalance / inefficiency is no longer there because this is an efficient price action, right? Displacement, just like FEGs, is inefficient price action. And then when we have like, you know, choppy, clear resistance, that's efficient price action. So the liquidity is all absorbed. And then when we come back, there's not as much liquidity to, you know, create that high probability move. Okay. Any questions regarding breakers? Because I know that one's a little bit more of a unique one. Everyone's got it?
One question for me. Does it need to create like liquidity before comes back into the breaker to
No,
be valid
so
to take trade? No.
traditional SND you do. Okay, if we're just looking at this as a buy to sell move or sell to buy move. Okay. If we're looking at this as just a traditional sell to buy move, then yes, you would need it, right? But breakers and order blocks are signs of institutional activity, okay? So
Okay.
if you know, follow the rules of what creates these types of SND or these POIs, by default, they don't need any liquidity because they kind of act as liquidity, right? So because we displace through, there's liquidity residing in here, right? These orders need to be, this area needs to be mitigated and then continued, right? Same with an order block. An order block is institutional activity, and as we come back to mitigate it and go, they typically will not need liquidity. The draw on liquidity is coming before its creation, right? So in this case, for this breaker, you have the draw on liquidity. Liquidity is already pushed up, and then the next draw on liquidity is somewhere up here. As price comes back, it simply just needs to mitigate and go. Of course, on the fractal nature, there might be, you know, some sort of other draw on liquidity, right, that you can use to confirm, but on this time frame, you do not need it, right?
Okay.
Yeah, it'll just be a continuation of the move. Okay, so I think we got all that down. Okay, POI stacking as well, right? So what would we look at here? Let me just draw this like so. Give me a second. Okay, so POI stacking, what would we look at here? This goes back to like last week's lesson of first line of defense. Right. So where are FEGs here? Yeah. Okay, so we have two FEGs, technically three if this one closes off. So we'll just do that here. Okay. Right. So you have FEG1, FEG2, and FEG3. Okay. So how do we know which one to pick? Excuse me, which one to pick?
The middle one because it stacks with a breaker.
Yeah, so we don't trade SND alone. We don't trade POIs alone like this, but when they're paired with a breaker, we understand that if this is the most likely area to hold, this doesn't need to fill. That's what we call a breakaway gap. And then this one also is weak because it's not paired with the breaker block or SND of some sort, right? So what we expect is this, right? And what do we know about FEGs? FEGs are a form of liquidity. So to answer your question there, that's extra, confluence that you don't necessarily need that buildup of liquidity before. Right?
Yeah.
Okay, so let's get into this. We're going to be talking about time and price. Okay. What do you guys so far know about time and price, if anything at all? Anybody open mic?
Nothing, just the kill zones. That's all I know.
Okay. So kill
And we
zones.
know- yeah, kill zone and opens.
Okay, kill zones and opens, right? So those are part of time and price, but they are the most like tip of the iceberg with time and price. Time and price backs basically everything that we do on, on an institutional level. Like, not that we are institutional traders at any means, but the way that the markets operate on an institutional level factors in time heavily, as well as price, right, together. Kill zones would be like sessions. So like London kill zone is 2 a.m. to 5 a.m. EST. The New York is 8:30 to 11 a.m. The Asian range is 7 p.m. to 12 a.m. EST. These are just, expected areas where there's more volume in the market. This is where institutions are doing business, right? Retail traders aren't moving the market, obviously. Institutions are, so we have to think about, what are the business hours that these institutions are mostly operating in, because that's when, we'll get the highest probability setups. We'll be able to understand that certain patterns in the market are representative of institutional activity, that kind of thing, right? But we'll get to that in a second. So let's talk about time price. So instead of writing it all out, I'll just copy it from here because I have a document open. Okay. So more than just the kill zone, we have time and time-based POIs. So what this means is that we can confirm the validity of a POI, for example, like an order block or a breaker block, right? Based on the time that it occurred. This could be, of the month, of the week, of the day. For us day traders, we're mainly looking at them from, the time of day that they occurred. So if you see, for example, a bullish order block formed in the middle of Asian session or spread hours, right? It's not going to have too much validity because you understand that, well, institutions really aren't doing so much business at that time. But if you see, pre-New York, for example, and OB happens at like 7:30 just before the open, then you can give it a little more validity because you understand that they're preparing for the day type of thing, right? They're doing business and then they're going to come back and hold that position for the rest of the day, right? The monthly, weekly, and daily expectations can be determined by time. So this is the opening price and how a candle forms. So in a bullish scenario, imagine this is a daily, weekly, or monthly candle. In a bullish scenario, you expect your candle to start like this, right? Like this, ignore the wick. Your candle starts like this. And then at the start of the open, you'll pull down. Imagine this is a monthly candle, right? Candle will pull down at the start of the month. It'll look bearish, right? But it will then close bullish, like so, okay? If you look at any group of candles, how often does a candle not have a top wick and a bottom wick, right? Very rarely. It almost always has a top wick and a bottom wick, right? So for example, this candle here, right here. If we expect this to be a bearish candle, then we expect a top wick, right? We expect price to come up into it, form a top wick, and then push down, okay? If we expect a bullish candle, we expect a bottom wick, and then a push up, a bottom wick and a push up, bottom wick and a push up, right? A bearish wick, this one doesn't have one. Bearish candle, top wick, pull down, right? So what we expect with the formation of a candle is at the open, we expect in a bullish scenario that price will pull down to some sort of higher time frame POI, for example, manipulating price, grabbing some sort of liquidity, some sort of draw on liquidity below before pushing up and then targeting whatever it needs to target, right? This is on a weekly basis, a monthly basis, a daily basis, right? So our job then becomes in a bullish scenario, okay, we're going to call this a bullish bias and bullish candle, would be to do what? If anybody was following like my stories as I posted them, I kind of talked about, daily highs and lows quite a bit. So our job with a bullish bias, expecting a bullish candle, would be to what? Like, what is the most obvious thing that might stand out to you right now?
So you just said like
What's that?
To move up,
Yeah.
I think.
Yeah, to move up. So so what is something that we could look for to be more confident in that the bullish move is taking place, right? Because remember that this is a monthly candle here, okay? Right? This is a monthly candle. So this is a month's worth of daily price action that's happening inside, right? On one candle. So what are we looking for to then hold that bullish bias for like basically the rest of the month almost?
The break of that candle or engulfing candle.
Short
or something
wicks,
like that.
maybe.
So okay. So what we're looking for is we're trying to determine in a bullish scenario, where's the low? If we can figure out where the low is, then we can confidently have a bullish bias for the rest of the month. Okay. So because we understand how markets or candles develop, they create a lower wick and then they create a higher move up and probably pull back a little at the end of the month, right? So our job at the start of every month, and the reason I'm pointing this out right now is because we're heading into a new month, is to look for that low to be created. How can we know when a low is being created? We have to look at things like manipulation, right? So what happens generally is in an uptrend. So this is most effective in trending markets. What we see at the start of the month on a lower time frame, maybe some sort of consolidation, which is similar to what we're seeing now. Then a manipulation to set the low, right? Grabbing liquidity, and then a trend that will start to push us towards, the high, right? And this is how markets are operating on monthly, weekly, and daily, right? So we have to do this exercise every single day, trying to determine where's the low or the high, depending if we're bullish or bearish. And then from there, we can have that bias backing our trade ideas, right? We'll get more into that in a second. Let's copy the next part here. Okay. Okay. So the next thing about time and price that is very important is POI validity based on time and price. Certain times of the week, month, or the day cause various behaviors. We must select TPs based on time and price. So we just covered that. When selecting a POI, ask yourself, when did it happen? You know, what happened as a result of that POI? Like, did it come from a draw on liquidity? Did it break structure? That kind of thing. Was there institutional involvement? So asking yourself these questions help you to determine that. And then if you can determine that, then you have more confidence in these POIs, right? So we're trying to step away from simply looking at it like a pattern of higher highs and higher lows, but just apply a little bit of there is a little bit of discretion involved, of course, but I mean, having a little bit of discretion and confidence backing what you see is better than just blindly following a pattern, right? You may be wrong sometimes, but you can't be more wrong than not doing it at all, right?
Yep.
Next section. Trending markets are manipulated based on time, okay? So institutional involvement is anchored on the monthly, weekly, and daily chart. Like most institutions aren't day trading, okay? We just happen to get involved on the market in these larger moves that are taking place on these higher time frames. And then like there's algorithmic trading that's basically running all day trading and intraday trading, scalping, all that stuff. But our job is really just to anchor our bias with monthly, weekly, daily. So you guys know that when we're framing trade ideas, we use an HTF, MTF, LTF funnel, right? But you can choose any 3 timeframes that you want. But this is different, right? For a scalper, the 4-hour or the 1 hour might be their higher time frame. But regardless of that, we're always anchoring our long-term bias based on monthly, weekly, and daily timeframes, okay? The opening prices, we can expect manipulation against the intended direction to push us in the intended directions, right? So just like I said at the opening, we're expecting some sort of a manipulation to the downside, maybe into a higher time frame POI or something, liquidity region, before pushing us up in the intended direction of our bias, right? So we expect manipulation at the starts of daily, weekly, or monthly candles. Look for manipulation into a higher time frame POI against the direction of institutional bias. So I just mentioned that we're looking for it. So if our bias is bullish, we're looking for manipulation in the opposite direction, grabbing some form of liquidity before pushing us up, right? This could be the previous daily high. This could be monthly or weekly level. This could be simply a buildup of liquidity and FEG. It doesn't really matter. That's where our whole trading plan kind of comes in. Any questions?
Nope.
Okay. So the daily markets, the way that we view them, open up at 12 a.m. So not when the daily candle opens at like 6 p.m., right? What we classify a day is 12 a.m. Okay. So our day starts at 12 a.m. and it ends at like 2 p.m. Okay. Because that's like when we're getting into spread hours. Okay. So 12 a.m. is the open, ends at 2. Where is the high and the low of the day likely to form? Okay, so if we understand how opening candles form and they open at 12, in a bearish scenario, where do we expect that the high is likely to form? All right, if we're in a bearish scenario, we have a bearish bias, we expect a bearish candle, where is the high of the day or high of the week likely to form? Above the open or below the open? Well, obviously it's not below the open because it can't, but we would expect that in a bearish scenario, right? So we're expecting a bearish candle to form. We're expecting to pull up above the open. This is the open. We're expecting to pull up, input the high, and then come down lower. So when we look at the high of the day, or the opening price rather. So daily open 12 a.m. What we can do is we can look for price in London session or New York session to come up above here, input a high of the day, and then push down lower. Okay, so we're going to dive a little bit into that. Why is this important? So there is liquidity above previous daily highs and previous daily lows. So if we are expecting bearish candles, we know that there is liquidity above here. And there is liquidity below here, right? So what we can look at is inside, this is, intraday price action. We can expect that if we're bearish, we're looking for a reason to sell. We can come into liquidity above the open of the yesterday's candle, liquidate it, see some sort of reversal, right, on a lower time frame, and then we can target, that low. We can expect that this is the high of the day, okay? So liquidity is the first reason of why daily candle is important. Also the formation of the high of the day. Session liquidity and session-based POIs. So daily, this has nothing to do with the daily candle, but we understand that every day there's 2 sessions, well, 3 sessions, but the 2 major ones, which is London and New York. So there's liquidity above the London session range. There's liquidity above the Asian session range, right? So we can look at these as draws on liquidity to then take shorts, right? So we're looking for manipulation of price, right? We're looking for areas of liquidity to come to, and then areas of liquidity to target. And a lot of the times being aware of where liquidity in the market resides based on time and price really helps you to frame extremely concrete biases, okay? For example, if we're in London session, we see a clear liquidity buildup just before a major POI, like an Asian range liquidity buildup, and we see a sweep of that, and we see order flow starts to shift on a lower time frame, we can be pretty damn confident that that would be the high of the day, okay? When we come into there, from that point on, we can expect to take shorts, okay? And this is I'm getting a little ahead of myself, but if we had a bearish London session, right, as a result of that, we can usually expect that New York is going to be some form of a continuation of London as well, right? So if we've like liquidated the Asian range to the upside during London, push down, and then it's New York, we can expect some form of a continuation to push us down and continue the formation of that bearish daily candle. These things here, like trending markets manipulation based on time. So this thing isn't as effective in ranging markets. The liquidity components are, but looking for like this manipulation of, the creation of the high and expecting an absolute dump for the rest of the day isn't very effective in ranging markets, but it's super, super effective in trending markets. So if we're in a trending market and we see consecutive bearish candles, what we're looking for at the opens, right, is that manipulation to push us down. But if we're in a ranging market, it's very hard to, expect that just because we've liquidated the high that we're going to come and put in a new low. Like this might happen where we get a reaction that's probably tradable. And what I consider a tradable reaction is like at least 15 pips. Like if you're not getting at least 15 pips, it's not worth trading. But we can't really in a ranging market. So imagine these daily candles were kind of just dicking around like this. You get some dojis. We're not going to expect that just because we've taken out one area of liquidity on the daily time frame, we're going to just straight push down, right? Let's talk about the weekly here. Okay, weekly. The daily bias, right, can be formed as a result of your weekly bias. So at the beginning of every single week on Sunday, I'll go back on the weekly time frame, figure out what, put down your areas, your draws on liquidity, your next likely draws on liquidity, where are we coming from, where are we going? These are the questions you always have to ask yourself, right? What is likely to happen? You know, if we're trending downwards on the weekly, where are we likely to pull up to? Did we just come from, you know, a high value liquidity area? Did we just take liquidity out of the market and we need to pull back? Where are we likely to pull back to? Did we just pull back and hit an area? Where are we likely to go next, right? These are questions that you constantly have to ask yourself, and that is what helps you to build concrete daily bias, concrete higher time frame bias to back your intraday trades, okay? Like, I don't want to sound like I'm showing off or whatever, but my bias, like, I'm not the best trader in the world. I don't claim to be the best trader in the world, but my bias is super concrete. Like, most of the days I'm getting an idea of where price is going to go. Not that I'm going to get involved all the time, and not that I'm going to execute perfectly all the time, but, you know, so far I've been really right about most of the biases, at least, you know, intraday. And this all comes back from doing all of this work on the higher time frame first, right? Because you understand that on a higher time frame, if we're expecting to push down, what we're asking ourselves is, what needs to happen on a fractal scale, so a lower time frame, so let's just say like on a 4 hour, what needs to happen in order to fulfill this expectation of the market of, you know, coming from up here down to here, right? So we look at areas of liquidity, we look at supply and demand, FEGs, right? What is the most likely development of price or journey or pathway that we're going to take, right? And following ISPs generally is, you know, what we do, right? So Eddie, you don't know what ISPs are because you're just checking us out, but ISPs are something that we follow. It's how we view structure. So we expect that like FEGs will hold when we have a draw on liquidity, and we expect that these will hold consistently until we get there. And that's kind of how we're building our trade ideas, are just following these areas of, or points in the market where we expect reversals to happen to take us towards our higher time frame target. So all of our prices are based on higher time frame targets. And then we use the intraday to make sense of it and kind of track that development until it gets there. But we're always anchored on higher time frame bias. Okay. And going back to here, institutional involvement is anchored on monthly, daily, weekly. Like, this is what we're looking at, right? We're just trying to be a little fish and ride the you know, the current of the ocean, right? Got it. Okay, so monthly. Oh wait, we didn't finish weekly here. Daily bias can be formed as a result of weekly bias. The high and low of the week is likely to form between Tuesday's London session and Wednesday's New York session. So I hate Mondays personally. Like, I'll trade them, but usually what happens on Monday is some sort of manipulation or range bound market. It's really hard to kind of build a daily bias on a Monday. But on a Tuesday, you will usually see some kind of manipulation that'll happen to start engaging that bias, right? So that'd be on a Tuesday, between Tuesday's London session and, so let's say Tuesday's London session and like Wednesday's New York session. So between this time frame, most of the time you're getting that high of the week or low of the week. Okay. So if we're bearish, we're looking for the high of the week. If we're bullish, we're looking for the low of the week. Okay, between the Tuesday's London session and Wednesday's New York session. Okay.
Yep.
Look for manipulation in a trending market. So we're heading into the open shortly. We have 2 days left of the monthly candle. So what we want to expect, I mean, we're not really in a trending market. That's the difficult part here. So this isn't the most valid information right now. But if we were in a trending market, what we'd be looking for is this manipulation, like what's happening between these two wicks, basically. What is the manipulation that's happening to push us into the high of the month and then continue bearish for the rest of the month, right? This is why it's so effective in trending markets. And if you look at a pair like USD JPY that trends extremely heavily right now against US dollar, go to the monthly chart and then drop down to the daily and try and analyze around the opening prices or the opening times of each month, the manipulation that occurs to then push us down. It might not be that clear here, but maybe there is also manipulation that happens here after the higher of data forms. So, but it's really good to go back and study that, okay? There's no concrete way, and it's really just comes down to you. Yeah, I can send all the text that I wrote. I have a document. I'll add it to this video and I'll upload it. And if you guys are writing it down, honestly, I suggest you guys write it down because that helps it stick more than having a document. Okay. May not be as effective in a crab market, but can still be used to select weak liquid regions and build expectations. So again, like if we're ranging kind of like we are now, this isn't the most effective model, but we can still take note of opening prices, highs, lows, closing prices, and expect that these are areas of liquidity. Of course, we never trade this alone, right? What we would have to do is, are these areas, these value areas, paired or layered on top of things that we trade, right? Like, are there higher time frame FEGs or liquidity buildup like on a lower time frame before these regions? But this whole higher time frame way of thinking isn't meant to make you profitable, right? Like, obviously that's why we're all here, but what it's meant to do is give you confidence in your bias, which, you know, helps with profitability when you're trading. You can
Stacking confidence.
Yeah, you're stacking confidence. It's like you can be profitable without doing any of this, but I don't know if you're anything like me, I kind of always need to know what the hell I'm doing. Like I can't just blindly jump into something. When I do, I slip up, I make stupid mistakes, you know, so having this extra bias on top of everything that I'm doing really helps, right? And like on UCAD, right? Like I took a trade. I thought it was a good trade at the time. I reviewed it and it ended up not fitting my rules. But it doesn't really matter to me because, you know, yes, I took a tiny loss. Yes, it was a shitty trade on my part, but I don't think that my plan is all of a sudden not going to work because I understand, like, I have the backing of this higher time frame bias now, right? Like I've done all this work where I can confidently say that even if I'm not performing my best on the intraday, my bias is still there and I can still make money or at least survive, right? So, you know, you're not always going to perform your best, right? But having this is a very concrete way of, you know, building that confidence in the market. Monthly. Expect range corrective open. So we just talked about that, right? So this would be an open. We're expecting a range in here because remember, this is a monthly price. This can last for days, right? This can last for days. It could potentially last for a whole week or even more, right? Before we get expansion in price. So we're expecting at the range opens and closes, or the monthly opens and closes, that we're getting range. And if we look at price right now, it's been ranging pretty heavily towards the end of the month. And then as soon as we get to the close, we can expect some sort of volatility. That's usually what happens. And on the opens, like right at the opens, first day, second day, we can expect a little bit of volatility sometimes. The main reason for this is, you know, the reason why it's important for us is that we want to be a little more cautious around these times, right? You don't want to be pushing. Like I don't want to, like, I'm not going to be pushing large trades. It's a scalper's market for at least the first, you know, few days of the opening month. Look for manipulation that is confirmed by the daily chart. Again, we've just covered that. We'd be looking for at these areas some sort of a manipulation on the daily, you know, maybe a daily break that can start engaging us in those that journey towards the next draw on liquidity, right? And what do we know about draws on liquidity? When we got one, those type 2s really start to hold, okay? When a high is formed, find your next likely draw on liquidity. So let's say that this is the high that's formed. We obviously don't know until later, but that's what trading is, right? We don't know anything for sure. Find your next likely draw on liquidity on the monthly chart and anchor to that bias for the month, okay? We can reevaluate at the beginning of each week to see if we're correct or wrong, or if we need to switch up on the bias. But generally, if we expect that the high of the month has formed, we're looking for that next likely draw on liquidity on the monthly chart, on the weekly chart, and we're expecting to anchor our higher time frame bias to that point until it's met. And that may happen in the first week. It could happen, 3 months from now. Sometimes your bias won't change on the monthly for 3 months, but we constantly have to refresh and reevaluate, right?
Easy peasy.
Okay. Yeah. Now let's get into some of the good stuff. Let's see here. Should I start here? Just give me a second. Okay. Okay, so this is some of the good shit here about why time and price is important. So we have power of three. Power of three just simply means manipulation, accumulation, distribution. Okay. So, or this actually, accumulation, manipulation, distribution. Okay. So what does this mean? Let's push this to the side here. Power of three means if we're bearish, right? This is the simplest model to trade, okay? If we are bearish, meaning we expect bearish price action to occur, what do we want to see to be able to trade this? Okay, so we have accumulation, right? Or simply a range. We have liquidity across the highs, liquidity across the lows. We're looking for manipulation of price. So a push up above these levels. So a raid on stops or a draw on liquidity, right? Liquidity to take, liquidity to target. It's all the same thing. And then a push down from here, okay? This is the manipulation. So we look for, in a bearish market, areas of accumulation, a manipulation of the highs, and then a distribution towards that draw on liquidity, that next likely draw on liquidity, okay? And we saw that on GU during London session. So if I was to, let's copy that just in case. If I was to go to what time frame was that, Bobbin? 15?
It was 15, yeah.
Yeah, so we can see that right here, right? Without getting into higher time frame bias stuff right now, we can see this was I swear this was a gap, but either
Yeah,
way.
so
Yeah, wasn't that a gap?
give me a second. Yeah, there was a gap, but maybe on a higher time frame.
Okay, either way, it doesn't matter.
On 1 hour, there is a gap.
Oh, it's the 1 hour gap. Ah, okay, yeah. So you have a gap here. Notice the time of day, right? When this happens, 3:30 a.m., that'd be the London kill zone. What's this? 23:15. Okay. Where is all my text? Let's go back here. I don't think I actually finished. Wait. Where's all my text? Okay, there we go. Well, I just got to add one more thing here. Here, I'm going to do this as well. Hold on. Anchored text, we'll put that to 10, just copy it all. Okay, so that'll stay on the chart at least, right? Let me just add the last little bits of this before we get into this any further. So we have these are like time-based liquid regions, okay? So these are very high value. We have Asian session range, we have London session range, we have previous daily high and previous daily low, and leak equals that happen at the right time, right? So we're looking for any of these areas of liquidity to be rated. So we are looking for these areas to be rated or drawn to at the right times, right? So we're looking for these areas to be rated at like New York Open, New York Kill Zone, London Kill Zone, right? So if we zoom in here, 15. Let's look at what is the Asian range. So the Asian range is 7 p.m. to 12 a.m. Okay, so 7 p.m. is, what is that? What is 7 p.m.? 17, 18,
Oh.
19. It's 19, right? So we have 19 all the way up into 12.
Oh, yeah.
Okay. So this isn't, we don't, obviously, we don't come up and raid this. This would be the high of Asian session, and then the low would be here, right? So we can see that we've swept below the low. And this gave us, you know, it's an area of liquidity, not that we'd be trading this, but this pushes us then, we sweep it again, but this pushes us up into this area of liquidity. Okay, so we're not sweeping Asian, but let's look for the opening price, right? If we go back to that drawing that I did earlier, if you remember, in a daily candle, we're expecting a bearish candle. We're expecting the high of the day to form above the open, and the opening price is at 12 a.m. Okay. So if we look at here, we go, where is 12 a.m.? Right here. This would be the open of this 0, 0, 0, 0 candle for EST. We can call this 12 a.m. Right. What we could do is we can extend this over to 11 p.m., meaning the end of New York Kill Zone. And what we're looking for, the high of the day to form above this region, right? Because this would be the opening wick. Okay. So what are we looking for? We're looking for an area of liquidity or some sort of premium discount POI to tap into above this opening price. Okay. And you could do this every single day. So what do we see here above? We see a 1 hour FEG. We see liquidity build up here. Right? Let's sweep into that liquid region, push down, and then on a fractal level, we can start looking for entries here. Or you could simply place the limit here. What do we know about FEGs? You can cover candle one, or the swing high, right? Or candle two, right? So, and then you would target that next draw on liquidity, wherever that may be, right? And this is called the formation of the high of the day, right? And now during New York session, I haven't done my analysis to see what the high of the drawn liquidity is, so we may have already hit that. But what we can expect is some form of a continuation of London session, given that we haven't, you know, pulled to our target yet. You know, if we have pulled to our target yet, then we may be able to expect a range bound or even a pullback. We'd have to wait and see, right? Oops, what the? Yeah, so is everybody following?
Yep.
Yep.
Any questions?
Nope.
Awesome. So if I pull up to the daily chart, what are we going to see here? Yes.
You can see-
What's up? Hold on. We got a question
Oh.
here. You can cue your mic if you want.
Okay, I'm just gonna. Can you hear me?
Yeah, I can hear you.
Oh, so my question was about the FEG. Can you just explain how you draw it? Because I was thinking that you had to draw it until the wick.
You do.
now,
So
yeah, like that.
yeah, no, you're right. It's just that this is an H1 FEG. Okay, so I should have wrote that down. But if I go to the H1 now, you can see realistically, it's actually from here to here. Sorry. right? So this is the whole FEG.
Oh yeah, okay, got it.
Yeah,
Thank you.
no problem. Right, so this is the entire FEG is from here to here, and now we're just tapping into that. So this is both the same FEG. Okay, so we have here, right? We have
Gotcha.
that. What's that?
No, gotcha.
Okay, no problem. So we have that higher time frame POI. Well, you know, framing the idea, or medium time frame POI, I should say. Medium time frame POI. We have medium time frame area of liquidity, right? What do we know about our entry model, guys? If everything's framed out on the medium time frame, what can we do when we hit that medium time frame area of liquidity?
The RR's favor, just set a limit on the
If
fair
it-
value gap.
If the RR is favorable,
It's
just set a
favorable,
limit. And
yeah.
I mean, even though we're on the 15-minute here, a 5 pip stop is unreal. Even, you know, a 9 pip stop in my book is really damn good. You can be super profitable trading 10 and up pips, right? Chasing tiny RR pips is silly. But also, now that we've come into it, yes, what can we do? Can we execute our entry model or no?
We
Yeah,
can
so
actually
I could drop down to the 1 minute here.
1 minute and see like
What do we
displacement,
look for? Clear
displacement, fair value gap.
displacement. Clear
Yeah, fair value
displacement,
gap.
right? There's this displacement. What do we know about, you know, having absolutely no liquidity in the leg, right?
Yeah, tends to get swept.
It tends to
whole-
get swept. So that's not to say that you can't enter on this, right? Just cover the high at least, right? Don't cover this. You're expecting that to get swept. Alternatively,
Yes.
what you can do is place your limit up here and cover that high. 3.6 stop, which is, you know, absolutely insane.
Yes, sir.
I would just take this larger trade any day of the week. But yeah, so we see that push down causing the break. Comes back up into our area. We have, let's go to the 5 minute, give some more clarity here. What do we see here on the 5 minute, guys? This is going back to our POIs.
You mean like we hit the 50% of the? or what?
No, we're going to what we were talking about yesterday or at the beginning of the session, breakers and order blocks. There's an order block here. Where's the order block?
What?
On the 5 minute.
Is it this? Right?
Exactly right.
Oh, there was a mystery there.
Yeah. So this is the order block. It's that last up candle before the down move. It can wick above. It doesn't matter. It's confirmed when we break below. It is now confirmed. And notice there's no liquidity in here. It does not matter. It is invalidated if we come above the swing high, right? But this is, so just because it wicks above, it does not matter at all. You see the bodies are respecting it beautifully. You can take a trade just like this, right? So this is, in my opinion, a much better trade than going on the 1 minute and trying to catch some tiny pip stop loss because you're going to get wicked out or something, and then it messes with your psychology. Then you're going to try and buy from here, trying to cash back up because you missed the trade, or buy from here, and then you're going to start messing up. And yeah, you know, that's happened to me 1,000 times over, right? And that's the trade right here, right? On the 5 minute. So you get a couple extra R going down onto the 5 minute. You risk not getting involved in the trade. Me personally, I would have just taken the 50-minute trade, but yeah, this is beautiful here as well. So going back to what I was saying earlier, if I go to a daily chart, what do you guys expect to see here? Anybody at all? Based on how price developed?
A bearish candle,
Yeah.
then like the open price, the manipulation, kind of like wicked above,
Yeah.
and then melt down. That's basically it.
Beautiful. So the thing about this is if I hop to the higher time frame, the daily chart, the high of the day of the candle is not going to be here because it actually starts at like 6 or something. Right? If I do this, go back to here, you're going to see that it's a little bit higher, but what we anchor our, where is it? Be right here or something. Yeah. We anchor our bias, our daily bias to 12 a.m. right? So what we would like to see is pull up manipulation. So accumulation, manipulation, distribution, right? So we're looking for that to happen above 12. And the reason now that we extend this over to 11 o'clock is because sometimes this might not happen up until New York, right? So we can start to do a little bit of this. And then at New York, maybe even around 11 with a news driver, we can pull up into this, start to distribute out, and then, take beautiful trades like that. Any other questions regarding time and price, logic behind it, all that stuff?
Yeah, quick question.
Sure.
The daily candle is 12 a.m. to 11 a.m. Eastern.
Yes. So that's what we anchor our bias to on an intraday time frame. Okay. Now, of course, if I go here on the daily chart, that's not going to be the case, right? Like the high of the day is here because this is how brokers operate, right? So let's see, got this, we got this, right?
Right.
Right. So if I go, we have the opening price, which is 17. And then the closing price, which is, or the high of this day is at 8:30, but where's the closing price? Would be at 17, right? So same thing. So you have 17 and 17. Sorry, I should have did, my bad, I made a mistake here. What I should have did was the opening close price, not highs and lows. There we go. Yeah, this makes more sense. Here we go. Okay, so opening price. Right here, 17. Closing price would be, it's not adding on, but 17 of the next day. So do it back here. I have to move that to the next candle. Right there. Right, 17. So that's on a broker, like the way it displays on the chart is 17. That would be the beginning of Asian session, right? But when we're looking for intraday trade ideas and manipulation, we're anchoring it to that 12 o'clock. Why did all my stuff delete now? Everything's going wrong today. Let's go back here. There we go. So yeah, when we're anchoring our bias here, when we're looking at the intraday chart, we're looking for that 12 a.m. level as our opening price, okay? Now the high and the low of the day is just whatever the high and the low of the day happens to be, and that's areas of liquidity. So as we can see right here, right? If we were expecting bearish price action here out of this day, you can look at this. We've swept the previous daily high and the one next to it. This is equals, right? So if I drop down to a lower time frame, this is equals. Let's go to the 15-minute. Right, so you have high 1, high 2. So these are the highs of Thursday and the high of Monday, right? We swept above it, started to break down. So you can use this as, framing your narrative, understanding what price is doing and where it's likely to go, right? So you're constantly asking yourself, okay, price came from here. Why did it come here? What is this algorithm, quote unquote, whether you subscribe to that or not? I personally do. What is this algorithm trying to achieve? Why is it doing this? It swept above the previous daily high of Thursday as well as Monday, and then it started to roll over. Is it possible that this is now the high of the week? Look at the time. Tuesday. It first tapped in Tuesday, London session. Right? Let's pull this up. Daily. Where is it? Weekly. High and low of the week is likely to form between Tuesday's London and Wednesday's New York. Okay, what happened between Tuesday's London and Wednesday's New York? This is London session. Wednesday's New York is today, right? So the high of the week is likely to form within this window. We're going to bring that back to 11 there, right? This is the high of the day is likely to form. Okay, we've liquidated, pushed in a high, started to distribute. Can we confidently say that this is more than likely going to be the high of the week?
Yeah, and like on the 4H, you can make
Yes.
it more clear.
On the
Because
4 hour,
like-
we can make it even more clear, right?
Yeah, external to internal.
If I just
liquidity.
jump to the weekly now, see this little bullish candle here or bullish wick? This is where it happened. Now we can expect from here that we're going to be, well, we're most likely going to be pushing in a bearish candle and possibly continuing bearish for the rest of the week, right? We ask ourselves, what is the next likely draw on liquidity? Well, I mean, the one that stands out to me the most is here, right? Stacking those confluences. So, I don't expect right away that this is going to come down bearish. And this is what I was talking about. This works best in trending markets, but we can still confidently say that targeting above here for this week is probably a silly idea, right? On the daily, we can see on, what day is this? Tuesday, we've pushed in above this liquid region, right? Notice here on the daily time frame, we don't see anything substantial. There's no FEG in here. There's no buildup of liquidity before. It just taps in above the highs, right? If I go into the 4 hour, you can see now we have equals. But what we like to do is work from the top down and build that bias, because price, right? How much easier is it to read this 3 candles of price than it is to read this? Right?
Holy fuck. Way more cleaner.
So what we do is we're always anchoring to that higher time frame bias, right? We're looking at the higher time frame first, building the narrative from there, and then we use, so like I say in the HTF, MTF, LTF funnel, higher time frame is all about narrative building, right? I'm going to pull that up for Eddie. Give me a sec here. I'm going to pull it up for Eddie. I'll post it in here just so you can see what I'm talking about here. Go to where do I have PDFs here? Here, check that out. I posted it in the Zoom chat. Let me know if you can open that up, Eddie.
Yeah, I see it.
Okay. So what do we see here? We got HTF narrative. We identify our draws, order flow, like what's driving price and daily range expectations. So what we're doing is we're building our see why it's a funnel, right? It's a funnel because we're putting most of the weight at the top and then we're coming down to the pinpoint, right? But let's assume that like the width of it, right, represents like time spent or energy spent, like focus, right? So at the top, the widest portion of this upside down pyramid, most of the time is spent on the HTF doing this type of the analysis, because all of this is confirmed by the lower time frame. All of this gives weight to the lower time frames. Okay, so the higher time frame here forms the bias. You do all your research here on the higher time frame, and then we go into the medium time frame. And if you look at the medium time frame portion of that, it says finding our way in price. Okay, so this is building a narrative on the higher time frame, but it's not tradable. I mean, it is if you want to hold for months on end, but that's not what we do. We find our way in price. So we're looking to confirm this narrative and build a story on the medium time frames that gives weight to this. And what can we see here? Let's go to the 1 hour medium time frame. We've hit that higher time frame area of liquidity. We have a higher time frame target. We're looking now to confirm it with the medium time frame. We can look at time of day or time of the week. Tuesday's London, Wednesday's New York. We've potentially created that high of the week. We're pushing down. We've created an FEG, right? FEGs are continuations of order flow. If we know that, if we can expect that this is the high of the day, right there, we expect that the bearish order flow should hold, correct? So now we've figured out where we are in the overall daily narrative, right? Using the medium time frame. This is executable by itself. You can literally execute on the 1 hour right now. You can execute like this. This is absolutely 100% fine and even hit some high RR, right? Alternatively, even this, where sometimes what I like to do is wait for the first tap into the FEG and then the liquidation of that tap. Sometimes you miss trades. Sometimes you don't, you get good RR, right? If we look at this, this would be your consequent encroachment, right? The 50% point of the FEG, right? And look at us tapping right, basically right into it, right? It's not going to be exact every time, but basically right into it before selling off. Yeah, what's up? What's the question?
So basically, you said that you do trade Mondays, but you usually wait for Tuesdays for the high of day 2 or the low of day to form for you to actually now get your buys in to
Yeah.
trade now the rest of the week.
Yeah.
All right, got it.
So, that doesn't mean I won't trade on a Monday, right? Like there may be a trade in here, right? There may be a trade in here. It's not to say that there isn't.
Right.
Do I have anything? Let's do quick analysis here. We've broken up. Yeah, it's probably, you have a little bit of a breaker, but that's not to say that I won't trade up, right? So we're in this sort of manipulation. I see this. Now I haven't looked deep enough into this to know that if I would take this trade or not, but I could frame my bias to say that we can push in towards these equals on the daily. And if I'm very confident in that bias, then I could take a trade on a Monday from here. Well, it's a Tuesday, but let's imagine this was a Monday, right? I could take a trade on a Monday and trade it up towards like liquidity, right?
Right.
I mean, this is a horrible example, but it's the first one that I saw, right?
Yeah. Now I got it. I understand.
Yeah. But generally, like your really strong biases for the rest of the week comes after you have that higher low of the week. Also, what happens is the manipulation, right? So power of 3, right? Going back to that power of 3. Who wants to tell me what power of 3 is? I'm going to hide this. What's power of 3?
Accumulation, manipulation, disruption.
Accumulation, manipulation.
Manipulation, disruption.
Yeah,
Distribution.
displacement, disruption. Where's all my text, man? Come on. Okay, my text disappeared. Distribution, right? So
Yeah.
we understand here, power of 3. You have manipulation. Let's make it like this so it's very clear to understand. Manipulation of price, or sorry, accumulation of price. So this is the accumulation of orders in the market. This builds up liquidity on both sides. The accumulation of orders. Manipulation of price means pushing price outside of this range into the area of liquidity, opposite of the intended direction, right? So rating stops. This fills orders. Rating stops opposite of the intended direction. So we have accumulation. Let's do this. Accumulation. Manipulation. This little area here. Manipulation. Manipulation. And then we see distribution, right? Accumulation, manipulation, distribution. So at the Wednesday, Tuesday, we see manipulation occur and we start getting our early signs of distribution. Now we can confidently say that, volume is going to take control, or displacement's going to start taking control. It's going to start trending very efficiently. We're going to see those type 2s really start taking control, and we can take a bunch of trades in that intended direction and completely ignoring all those little stops on the way, like completely ignoring something like, oh, is this a tradable area, right? Completely ignoring getting caught on the wrong side here because we've built that higher time frame, weekly and daily profile, right? So because I have this weekly profile now, from today, if I was trading today, which I've already completely missed the move, If you were here during London session, right, you could confidently hold a trade like this with very, very little issue because you've built out this weekly profile and we can understand how the week is likely to continue, right? And we're
So-
probably going to come even lower.
Question.
Yep.
Jeff. So just back on the daily where you had that liquidation of that candle, that
Yep.
is simulation and manipulation. So if the bias was to go bearish, then usually we would see that liquidation and then coming down into the lower time frame would see more of this power of three.
Yeah, and that's what it is right here, right? This is the fractal power of three of accumulation, manipulation, distribution. So this is the daily, right? So this is at a few days, and then this is both today. So this is the buildup of liquidity for from Thursday last week all the way up until now. We've then manipulated it and then distributed. But on a fractal nature, if I go down to the 15-minute here, you can see again this happening, right? So we have a higher time frame FEG, the H1 FEG. We have accumulation of orders, right? We have manipulation of price above the high, and
Yep.
then we have distribution where we're coming below the low, and then it ends up continuing, right?
And then we've got the confirmation that it's going to go down because it's just breaker structure after breaker structure.
Yeah, and what do we know about the draw on liquidity? As we view it, type 2 should hold. If I go down to like the 5-minute, this is probably type 2's like steadily hold, or 15-minute, 15-minute, 5-minute, 15-minute, yeah. Type 2s are steadily holding. I mean, we haven't really gotten much because in this case, it's been extremely impulsive, but we have one.
Yep.
The next type 2 would be here. Right, and that holds. And then, if we were not so impulsive, we could likely catch another one as well, right? Until we hit that draw on liquidity. I don't know if this is the draw on liquidity. I'm just using that as an example.
I think it's just a demand zone. If you go if you go across, it's just a demand zone on the 15-minute anyway.
Yeah, okay, so just ignore this, but yeah, okay. So we're likely like coming down into liquidity. And what do we know about type 2s and type 1s when we come into a high time frame area of liquidity? We expect that type 2s
Should not
what?
hold.
Fail.
What's that?
Oh, okay.
What'd you say? Was that
Fail.
Bauman? They fail. Oh, was that Christian?
Yeah.
Yeah, they fail. We expect that type 2s fail, right? So we can expect that this will get taken, as liquidity. And so on and so forth. And I believe if we look at this, I believe in my forecast that I mentioned, this was maybe at the beginning or sometime last week, or maybe it was the beginning of the week, that if we roll over, that this is likely the target of liquidity. And the narrative is starting to now build out that this is in fact going to be the target, and coming into for the next week, this is likely, where we're going to be trending, right?
Question on this EU.
Yep.
The Asian high was taken as liquidity,
Okay.
but before the Asian high was put in, we were looking at this point being the
on. Yeah, I
next
changed
likely
the
drawn
chart.
liquidity. Oh, sorry. Wrong. This one was the next likely drawn liquidity, but this one here is the Asian high. So how do we differentiate between what we would, do we have to keep updating our next likely drawn liquidity, if that makes sense?
So your next likely drawn liquidity is your target, right? So let's just say that this is it, right? Okay. So we had, let's go up to time frame. So we had your 4-hour POI that we came into, and we're expecting that this
Right.
holds, right? So
Correct.
this is our draw.
Okay.
This is the next draw,
Correct.
right? And now we're looking to confirm that on a lower time frame. So this is where we incorporate time of day as well, right?
Okay.
So
Mhm.
if we're looking at this, right? So this is all central bank dealer range shit, not important. 17, right? 17 to 12, right? So this is the high of the Asian ranges right here. So we actually don't even come above it. We actually don't pierce above it. At least on
So-
this broker, we don't pierce above it.
You said that the Asian high was 19 to
Oh, 19. Yeah, you're
Two.
right. No, you're right. You're
Right.
right. My mistake. Yeah. So,
so
where is
then
it?
this
17 is the opening price of the other candle.
okay.
Yeah.
So
So
then
we would look at this, right? So we're looking to build it. This doesn't really matter. Okay. What we're looking for is
Okay.
time of day and areas of liquidity, Asian session range. So this is the reason why this doesn't matter as much as this. Okay. This, not to say that this can't come up, push above higher, right? I'm not saying that at all. But it doesn't need to. And the reason I say that is because now apply logic with time. Okay. Institutional involvement. This is spread hours. All the businesses are done. They're done dealing. They're done dealing in the Forex market. They're going to wait till tomorrow, which means that, and you can see this in the spreads on your broker, spreads are extremely wide during this time because liquidity is extremely low. So above these highs is not very much liquidity. There's just because they're highs. See, this is where applying logic to your, this logic of time and price really comes into play rather than simply looking at candlestick patterns, because we're trying to not be pattern traders as much as possible. There's not many orders in here, which means there's not many residual stops in here, right? Versus in Asian session, which is, where is it? So let me bring this over to 19. Asian session starts, you see it pull up, a push down, heavily displacing, right? This is institutional involvement. Institutional involvement is determined by time and price, right? So time of day, we understand that this is okay, whatever. This is not, doesn't want to, okay, yeah. So this is Asian session, right? Right. And we understand that there are still, businesses around the world that are operating in Asian session. This is the high of Asian session. This is where they put their orders, right? They put substantial amount of orders in here. Above this high is where stops reside. Okay. Not above here, because businesses aren't doing business during these hours. Businesses are doing, or institutions are doing business during Asian, London, and New York. So we
understood.
prioritize.
So I was using this as the liquidity for, so I was looking for this to come up and then drop. But now that you say that kind of irrelevant and this is the only relevant point, I
Yeah.
got you. Okay.
So now we confirm that through lower time frame order flow, right? So of course it's quite difficult to be confident that this is not going to get ran. It's actually impossible to, it's impossible to guess, right? We can't guess. So what we have to do is we have to add stuff on top of it. Now, this alone, taking a limit here, covering the high, is completely acceptable trade. Okay. This is a completely acceptable trade if you're some form of higher time frame trader and you expect bearish price action, because we understand that price can come up significantly higher and liquidate all of this and you could still be in the trade, right? But I don't trade like that. So what I would do is when we come above the Asian range, we go to our medium time frame, like the trade funnel, trade idea funneling system, right? We go to medium time frame. We're looking for MTF, liquidity to trade from, right? If we've now hit that, like we have, we can then move to the lower time frame 4-step entry model, displacement order flow shift, FEG, right? So I can come into here. As soon as we hit this, I can then go into the lower time frame and look for the entry model to play out. And what do we see here as soon as we raid liquidity? Order flow shift, displacement, and FEG? Where do we see that? Anyway, Christian, if you want to mark that out.
Yeah.
Okay, remember, order
So,
flow shift is
our
different from SMB, but
FEG
I mean, it
here.
happens to be the same thing in this case. Yep.
Our shift is here.
Yep.
And then order block would be this one. No,
Yeah.
sorry.
No, you're not wrong.
Oh, okay.
Yeah.
I was thinking breaker block just now for some reason.
No,
Yeah.
no, this is, you're actually on a lower time frame. This is breaker block, but I mean, this is the thing, right? When we're talking about such small price action, like you can just do the whole high. It really doesn't matter, and just view it as SND, right? Where would we set our limit?
Gotcha.
Okay, so
Uh,
rule of thumb, when it's
person.
this small of a range, I generally will just select the body of this candle, cover that high, right?
Okay.
Like so. So rule of thumb. But yeah, we see our entry model play out. So our entry model is displacement causing an oops. So we have liquidity. Step one, hit a medium time frame area of liquidity. We have medium time frame area of liquidity at the right time of day. Okay, so we're adding that to the entry model now. It has to be at the right time of day. Order flow shift, right? Ideally an SMB, but if we have a very strong bias, an order flow shift will suffice, right? I mean, on a lower time frame, this is an SMB. As you can see, we've reacted to imbalance. We've filled imbalance, pushed up, broke. So on a lower time frame, that's SMB. FEG. And then we can just limit the FEG at a minimum and cover the high, right? Targeting, for example, this low, right? Easy peasy trade idea. Or if we're confident that this is the start of the week, we can hold these trades, you know, significantly deeper, right? And if I exit chart replay, well, we've reversed now, but yeah, you get the point, right? This is what, EU? Yeah. Right, at the very least, your first target is down into here, right? Which is how I like to trade, just take it at that first all in, all out, one shot, one kill type of thing, right? But I would say if you want to hold this trade, I would say that you can easily hold this trade pretty significantly. I don't see this coming up above here if we are in a bearish week, right? If we are in a bearish week, it should not come above here. And it most likely won't. And in New York right now, we're probably coming back for a continuation style trade right now, right? Yeah, well, exactly, right? If I go up into a new time frame, what do we expect if until we've hit that draw on liquidity? That these type 2s, so Eddie, we're looking at FEGs here. So this would be the type 2, but this is the SND zone that caused the FEG. So yeah, you're 100% right there. This is likely a continuation point to continue us down because we have now anchored our bias on the weekly time frame that this is the high of the week. Well, actually, technically, this is the high of the week. This would be the high of the day.
And then don't we also have this breaker block here? Oops. Or is that not a breaker block?
So because we've had resistance and not displaced through it, it's not a breaker block.
Understood. Yeah.
Yeah. So I mean, this is just a flip, right? I mean, I don't usually look at flips, but it is a flip, right? We all know flips, and it's more than likely going to hold here. Let's
Wait,
go
I
into
had,
one.
I had like a kind of different bias
is-
for this one.
Yeah. What's your bias?
Wait, can you go like on the daily? Wait, let me draw. So basically we had like our next draw on liquidity this, because this is weak, right?
Okay.
We had a like sweep of inducement, and like just like you said about the daily open close, like this is let's say this is a bullish candle, right? What do we
Mhm.
expect this candle to pull up, manipulate some liquidity, and then take the next high, right?
Yep.
So if you drop on like a 45 minute, because like I went through time frames to see what is like the clearest thing. Okay. So we had like this filled liquidity. This is our ISP, right? And this is my next round liquidity.
Yeah.
This
I
was my
mean,
bias.
you can be wrong, or you can be right, and you can still make money, right?
Yeah.
That's the beauty of being a day trader, right? you can anchor your bias to this and be completely wrong. I mean, for me personally, my bias is sell side, based on everything that's been happening here. But am I saying that I'm right? Absolutely not. I could be completely wrong, but because I'm able to just take, 4-hour, 5-hour trades, we could both make money.
Oh yeah. I got
And
you.
we could both be completely wrong, right? This can end up just doing this. You know what I'm saying? But we could both make
Yeah.
money. So as long as you know the area that you want to trade from, the draw and liquidity you want to target, and you know how to manage your risk, you can make some
Yeah.
money off a trade from like here to here, right? Without needing to
got you.
hold, or you can trail stop, whatever it is for you, right? And that's what the whole testing phase of this whole program is going to be about, is you figuring out your style, right? Yeah.
It just made more sense to me because like
100%,
you
that's
mentioned,
okay.
the open and close of the candles made more sense
Bias
to me.
is 100% unique to you, right?
Yeah.
It's used less. I mean, you want your bias to be right the majority of the time. You're going to be wrong sometimes, but as long as you have a concrete bias you could stick to, even if you're wrong, you can still make money because you could be temporarily right? And you would be temporarily right now, assuming that you're wrong in the future, right? Or I could be temporarily right and be completely wrong in the future, right? So
Yes.
we're using
That's
all
why I'm
this
asking you.
100%. We're using all of this
Yep.
higher time frame bias building and narrative building to be right for maybe a couple hours max. You know what I mean?
Yeah, for one trade only. Yeah, I got you.
So that's it. Any questions?
I wanted to ask you if you can go on USD CAD, like if I'm seeing this right on 4-hour. Like this zone here, could this be like drawn liquidity, and then there is like whole imbalance over here, right?
Yep.
So there is a breaker block.
Yes, there's a breaker block.
So I mean, like, is this like possible scenario, right?
It is a very possible scenario. So let's take a second here. I know this is getting a little off topic, but let's look at this. We have liquidity before, not that that's 100% needed, but we have, liquidity before. We've come from a higher time frame draw on liquidity. Okay. Pushed up. This is where we'd have to factor in our other analysis, like what is our higher time frame analysis of the DXY, et cetera, other pairs. Do we believe that the DXY is going to go down? If the DXY goes down, then USD CAD goes down. If DXY goes up, then USD CAD goes up, right? Because that's dollar strength. USD CAD is different from Euro USD, where the foreign pair comes first. In this case, USD comes first, and then the foreign pair comes second. So that's where it really comes into play there, but let's just follow structure here for a second, right? So on the 4-hour, right, we have what? That's a type 1. We have a type 2. I don't see long-term swing points. Maybe on the 1-hour. We have type 2. We've now broken this one here is also type 2. We've broken it. So there's a possibility that we form a long-term swing point from here. For me now, what do we know about long-term, swing points? How do we characterize them? What are the characteristics?
ISP on
Okay,
the left and the right. Okay, fuck.
What were you going to say?
Same thing, ISP on the left and right.
Yeah. Okay. So if
Or
we
lower
understand that.
or higher than it.
Yeah. So it's an ISP on the left and then an ISP on the right and then a higher one in the middle. And when we have, right, our 3 green dots like this with a higher one in the middle, this one becomes a long-term swing point, right? Right now, what do we see, Bobin?
Now what we see is like just displacing to the buy to pick up like sell side liquidity, but
Right. And what do we see here though? So we've taken liquidity out of the market.
yeah, and then after that, like we
have this. What do we see here?
SMB,
Right.
SMB,
So you have SMB. So if an
And
SMB, an
then-
SMB is when ISP takes out another ISP.
Yeah, so in order to like hold this bullish structure, this would like need to hold, like this is the last point. So it should be happen something like this if we want to see the bearish movement, right?
100%. So if we say that this can potentially be a long-term swing point, we understand that long-term swing point means that there's a higher or a lower ISP to the right. Instead of trying to trade just from this, it's better for us to wait for that narrative to build up. Power of 3, manipulation. Accumulation. Manipulation gives us that ISP. Distribution, take the low, right? So because this is an interesting scenario, and this is why the way that we've mapped structure can be so effective and in protecting you. We've had this SMB and we've come from a higher time frame point, right? So we don't know if price wants to continue up or if we want to continue back down. So it's best to wait either for a new bullish ISP to form and break the high and then take continuations, or this one to form that manipulation where we can form another bearish one and then start getting on these moves as they happen towards the draw on liquidity, right?
Okay. Yeah, and one more thing, and I'm not gonna like, I know that we're off topic. Could we consider this as a swing point? Because like I see also this here as an ISP, and that this is like a broke of the structure of the swing structure.
Yeah, we can. So if we let's go blue. Yeah, I didn't notice that at first. Okay. Swing point, this could be break of swing. We really have to see, you know, how is this going to develop? Like we've barely closed above it. Is this just going to immediately start to come back into the range? If it does, then I would not even classify this as a break. I would just call this like equals, or some sort of liquidation, right? So it's
Yeah.
possible that we come back. We just don't have enough information yet, right? And
Yeah,
coming
yeah.
from a move like this and a draw on liquidity and an SMB, like I don't want to be selling from here right away anyways, right? So yeah, that's correct. But what's more important is actually building the narrative of what's going to happen here.
Okay.
So just because we've
Makes
had this doesn't change the fact that, doesn't immediately make us bullish and expect that we're going to start running up the price, right?
Yeah.
Okay. Any questions regarding that? A little off topic, but that's okay.
No, I'm all set. Thanks, man.
No problem. Okay. Any questions regarding time and price? I'm basically done everything that I wanted to show you guys regarding that, at least for now. I'll keep drip feeding information through the course, through the membership portal. Like, how to trade Asian range and all that stuff, like in small bite-sized videos. But overall, I mean, I've gotten the main concepts down with you guys here. Any questions?
Nope.
Anybody
Definitely.
at all? Nope. Okay, then
Nope.
then we're gonna call it a day, guys. How'd you like this one? This will be pretty much the end of the theory side of things. We're gonna get into trading really soon. At least case study building.
We already got in.
Yeah, well, you guys already got in, but that's not that's on your own time, bro. That wasn't part of the plan. You guys just can't. You guys are rockets, man.
Yeah, just quickly.
Yeah.
Does the liquidation of the London
Range?
high?
Yeah, so we can look at London range liquidations as well. So that's not something that I'm particularly really well versed in. Like I haven't personally tested it myself. I know that it is correct though. Look at that, beautiful. We unfortunately didn't come up into here, but that's okay. Still
No trade,
gorgeous to
mate.
look at, man. Then that's just again following that bias here for the day, right? So you being able to have that concrete bias, we can just understand that just because we pulled up now and that was a big fucking green candle at one point, right? And that's scary to look at, but because we have that anchored bias from the higher time frame, we can just disregard it and be confident that we're going to come down lower. Or, you know, in 30 minutes after I end up this call, this gets taken out, I'm an idiot, but whatever. Yeah, so, yeah, no problem, Eddie. I'm happy you stopped by, man. Glad you get a look. Hopefully you found some value too. For the rest of you guys, facts, man. Thanks, bro. For the rest of you guys, I'll see you guys in the chat. Study the shit out of this, because this is now, like, everything I've taught you before is leading up to this, and this is all given weight, or everything that we've learned to this point is given weight by understanding time and price.
Got you.
Yeah.
All right,
Easy,
guys.
easy.
Thank you.
Yes, sir. No problem, guys.
Thank you.
Chat later. See ya.
Thanks, man.
Ciao.
See ya, guys.
Bye.
Bye.